All right, welcome to the recorded lecture all about ratio analysis. Okay, so what we have here, I extracted Walmart Inc.'s consolidated statements of income and then consolidated statements of balance sheets. Okay, so when you talk about ratio analysis, there are some formulae that you can use, which will enable you to analyze the financial statements in a much detailed way. And this so-called ratio works like an indicator. Okay, it may be indicating that something is wrong or something is not doing properly or things like that. Okay, so and if you are a reader of the financial statements, for example, if you're a bank manager or a supplier or even a customer, you might be interested on some information provided in the financial statements. Okay, so as we go along, we will try to explain those ratios and then we will have some conclusion about it. So you can pause this video so that you can always or you can recall or can get some information that you might need in calculating ratio or ratios. And also you can always return to the return to the video or certain parts of the video so that you will be able to uh, see information again that you might need in analyzing financial statements using ratio analysis. Okay, so we have here sales and then up to the income. Okay, consolidated income, we have it here. And we have balance sheets, we have the assets, liabilities, and equity. Okay, so let's go to the analysis. So the first thing, on ratio analysis, we have current ratio. Current ratio focusing on liquidity. Okay, so in this aspect, we're talking about whether the current assets will be enough to cover for current liabilities. Okay. So in this case, we had got year 2022. Okay. And these are the items from the balance sheets. Okay. So when we divide current assets over current liabilities, we have this 0.9 uh, 928. Okay. This industry averages I'll put this is just hypothetical. Okay. I just assume that these are figures. Okay. So let us say the industry said the industry average will have two current ratio two, meaning two current assets over liabilities. So twice they can cover for liabilities, but for Walmart in this case, we only have zero point 0.9. Okay, so which means current asset is not enough to cover for the liability. So my comment here, low current ratio indicates that the company has liquidity issue. Okay, comparing with industry average, the company is not doing well in terms of uh, liquidity. Okay, possibility of non-fulfillment of currently maturing debts. Okay, so think about it in the perspective of I said maybe you're a banker or a supplier or a customer or even government. Okay, how will this play a part on your decision making? Right? So that's one way of using current ratio. For example, if I'm the supplier, I'm interested whether the company will be able to pay me. Okay, and this kind of ratio, I'm a bit of a doubt in doubt with the performance of the company because the current assets are not enough to pay the currently maturing debt. So I'm a supplier. I would require to collect uh, as quick as possible, of course. The same interpretation will be given in quick ratio. Now, in quick ratio, we are removing other current asset. We're only focusing on three items: cash, marketable securities, and accounts receivable. The accounts receivable is included here because it's easily to be converted into cash. Inventory, on the other hand, is not included because we still need to sell it it may be credit sale, so meaning it will go to accounts receivable. So better not to include inventory here. So same interpretation. If you have low current ratio or quick ratio in this example, there's a problem with liquidity. Okay. Now, receivable turnover. Okay. Net credit sale, our assumption in net credit sale, I included here, 40% of the total sales will be credit sales. Okay, so for ease of interpretation. Now, average receivables, in this case, you have to get the opening and closing balance, the sum of both, and then divide 2. Okay, so that's the average. So in this case, the receivable turnover is 30.70 or 30, shall we say, or 31, sorry, rounding off. Industry averages is 30. In terms of this receivable turnover, our collection is at par with industry. Let us say Walmart's, in this case, collection is at par with the industry. Okay. And if the company has a higher receivable turnover, it means that they are collecting, uh, they have more collection cycle comparing with other industry. Okay. Uh, be mindful that Walmart is a retail industry, and then most of the sales happening are not most, but majority will be cash. Okay. So there might be some credit sales happening, especially with their trusted customers. Now, inventory turnover, we have cost of sales and then average inventory. Same with receivable turnover here. Opening inventory and then closing inventory. The sum you have to divide by 2. Now, if there will be low inventory turnover comparing with industry, it means that the company may not be selling their product as fast as they can comparing with the industry. So what is the implication there? If you are, let us say, a buyer, you might be wondering why is it that the company is not selling their product as quick as possible. There might be problem with their product or problem with the place there where they're selling. Okay. Also, if you are a supplier, then you might be worried. Wait, they are unable to dispose of their inventory. Shall I still provide my products to them? Okay, because it might indicate uh, profitability issues. If they're not selling fast or as quick as possible, they may not be able to have available cash in the future as they may need it. Now, the next ratio is debt to assets ratio. This talks about a long-term liability. So in this case, we're talking about solvency. Okay. So solvency, we have, in this case, total liabilities, we have that figure 100,859. Sorry, the amount is in million of dollars. And then we have the total sales here. So that debt to asset ratio is 41%, while the industry is saying 60%. Now, the company doesn't have the high gearing ratio. In that case, what does it mean is that we are not too dependent, okay, for loans. We have our available cash, which may be a good sign, okay, of course. If you're not paying so much or you don't have much loans, you're not paying so much on interest, okay. So this may indicate a good solvency position. Now, gross profit margins, we have gross profit over sales, okay. So here we have this amount 138 762 divide 567 762. We have 24%. Okay, while the industry has 30%. So issue here is that why the company is spending so much. If you have a low gross profit, it means that you have high cost, okay, over the product. So question is, why is it that they're spending so much on product comparing with the industry. So this will be have a relationship with profitability. Now, net profit margin, we have ignoring the tax effect and then having the tax effect. Okay. So in this case, we have this figure, net profit and margin. Okay, we have 3% without tax and 2% with tax. It is at par, or both of these items are at par with uh, the industry. So in this case, take note that these financial statements had been affected by COVID-19. So possibility is that they spent so much on operating expenses that they had to pay those operating expenses and affected the profit. Okay. Now, in normal cases, profit ratio advisable will be between 5 to 10% to be considered good. All right, so that's the end of my recorded lecture. Hope you learned something.